Hello, welcome back to Mortgage Nightmares. This is a show where we dive into the chilling world of real life home buying horror stories. From deals gone disastrously wrong to shocking scams and unexpected twists. Mortgage Nightmares reveals a dark side of real estate through the experiences of those who lived it. Join us each episode as we uncover the terrifying truths behind buying a home and provide insights to help you avoid a nightmare of your own. Now, this is episode 3. So if you've been tuning in, following along, you've already heard some pretty crazy things that have happened before. Today, we actually have a story that does have a good ending, somewhat good ending. It could have turned out better for the client, but at least it wasn't like the first couple of ones
where somebody went to prison, somebody lost their life savings.
Or yeah. It's not like that. But it is a very good lesson as to what can happen and also how to avoid that from happening in the future. So, my name is Ricky Nava. I'm your host. And for those of you who might be tuning in for the first time, I am a loan officer here in California. We are also licensed in 9 different states. A lot of these stories will be personal experiences, and some of them will be shared by you or by our colleagues and coworkers who have gone through the same thing. I'm also here with my co-host, Clay Murray.
Absolutely. Thank you. Yes, episode 3, ready to rock. Again, my name is Clay Murray. I am the branch manager and senior loan officer of Military Home Loans, a San Diego staple. We just celebrated our 20th year in the industry, in the community.
Congratulations.
Obviously, thank you. Yeah, specializing in VA loans, but offering all types of mortgages. And I am celebrating my 10th year, actually about to turn the calendar over to number 11, which is unbelievable. But in that 11 years, we've seen some stuff.
I believe you are 1 year?
1 year.
A year and a half.
You're a senior. I don't know. I think it's just
somewhere around there.
Yeah.
And fun fact, we actually joined our first company. We were at it together, and then we split ways for several years, and then reconnected again.
Absolutely.
Here we are.
And now we're doubling down.
Now we are. Now we're hosting our show.
Yep.
But actually, the idea for this came about because there are a lot of crazy things that happen. A lot of things that happen. And unfortunately, a lot of these things are avoidable.
Mm-hmm.
But especially if you're a first-time home buyer and you don't really know what to look out for or really what you're doing, that's where these things kind of come into play.
Yes.
So obviously, some things, there's nothing you can do about it, right? If your escrow officer gets arrested, during the transaction,
that's a little outside of your
control. You
control.
Can't really prepare for that,
Yeah.
right? So, which, by the way, if you haven't listened to the last episode, go back and listen.
Absolutely, that's episode 2.
That is a juicy story.
Yeah, but you know what? You're right. I mean, there's a lot of things you can prepare for as a consumer. There's a lot of things that you cannot prepare for. And as a first-time buyer, there's a lot that you don't even know you don't know. But at the same time, you're putting your faith and trust into that of a professional, right? A loan officer or an institution or a bank or whatever it is. But not all of those are created equal. And that's kind of what we're going to be talking about today.
Right.
And
exactly.
These nightmares, I kind of think of them as travel, like airfare travel. We've all had a great flight. Everything goes great. You board on time. Your bag gets there. You get there, and the vacation is awesome. There's mortgage transactions just like that. Then there's some that have some turbulence, but you still end up there. Then there's some where you're snowed in. You're spending the night at an airport. You're missing your flight. You're missing your hotel. All of it. And those are the nightmares that nobody can predict. So those are the things that we're excited to cover on this show.
Absolutely, yeah. So today's episode, we will be talking about, well, you know what? Let's set the scene.
Yeah.
Let's go ahead and set the scene. So what we have here is we have a young couple, first-time homebuyers, never been through this type of thing ever before, haven't even been pre-approved before, right? It's first time, everything, completely new, completely green. So they did the right thing. at the beginning, they came to me because I am very good at educating first-time
Sure.
home buyers,
Yeah.
right, on the process, which is not necessarily the norm, right? Especially if you go to a bigger bank, which we will talk more about bigger banks in this episode. They were contemplating using their current bank that they have their checking account with, which I shouldn't say the name, probably, right?
Yeah, we've tussled with that
Legal
idea of whether or
reasons.
not
I
we
don't
do.
know. I don't.
Yeah.
I don't want to run the risk of
Let's
getting
just
sued,
let's
even
not.
though it is a true story and it really did happen. Let's just say that they were one of like the big five. You know, you have your Chase, Wells Fargo.
Okay.
Well, it's not about them. I can mention them.
You're gonna talk about all the ones it's not about. Okay, got it.
Yeah. It's not about Chase.
How about we
or
do it
Wells
like this?
Fargo
There's the one with the horse and buggy. There's
Okay.
the other one that is a guy's name. It starts with J.P. Morgan, and then there's this one, which is like a representation of our country.
Let's just say it rhymes with Bank of Erica.
Let's say that.
All right, but I'm not saying the name.
No,
I am not saying the name.
it
But
may or
anyway,
may not rhyme with
Right.
Bank of Erica.
Right. But anyway, the whole point is that they were considering using their bank,
Yeah.
and they decided to contact me because the realtor they were working with, I have a relationship with them, and she said, "Hey, this is my preferred lender. I really suggest that you talk with him." So, again, my whole point behind that was that usually a lot of big banks won't take the time to educate you as a first-time home buyer.
Mhm.
They just have too much business, too many people coming in and requesting not just mortgage loans, but all the other products that they offer. That they don't have time to sit down with you and go over everything.
It
right?
seems that way. Well, and there's probably some loan officers out there who will disagree with this statement, but I think most of the industry will agree with the fact that a big bank is common to have a mortgage loan officer that is either starting their career or probably ending their career, right? Somebody who doesn't have a lot of experience or
That's a good
doesn't
point.
necessarily care to really invest in, outlining what to expect for their clients. Like
Right.
you said, you do a great job of, and I can attest to that.
Yeah, no, that's a good point because for those who are not in the industry and don't know how loan officers get paid, we get paid commission, right? And most of the time, you are full commission.
Mm-hmm.
The commission's not paid by the consumer. It's not paid by the buyer. It's paid by the bank.
Yeah.
Now, when you work at a bank, usually how they do it is they might pay you like minimum wage or some sort of starting small salary
Yep.
with a small amount of commission on top of that.
A flat commission.
Right. And
Right.
it's usually a smaller amount. So bottom line is that if you're a loan officer, you're most likely making less money working at a bank than you would working at something like us, like a retail lender,
Right.
or a broker, or a direct lender. So
And as a result, then the big banks don't command super seasoned professional loan officers because those people can go get a job where they're going to get paid what they're worth.
exactly. So usually a really good loan officer who's been in the business a while and knows they can make more money somewhere else is not going to go work at a bank, which is why, like you said, it usually attracts either brand new people who are new to the industry, don't really
Yep.
know what they're doing, so they can teach them, coach them, and all that, whatever. Or, like you said, someone ending their career where they just want a steady flow of business and don't really care about making less money.
Okay.
Right?
Yeah.
Now, that's important because if you do have someone who is not seasoned or new and green to the game, then they might not know how to guide you, right?
Mm-hmm.
So that's important to know. Now, in this situation, they came to me. They were working with, not working with their parents, but their parents were involved in the transaction. They were helping.
Okay.
So they
Super common, especially
Yeah.
for first time buyers.
absolutely they want to help. They had requested if I could actually make a house visit, which obviously no bank's going to ever do that, right?
No.
They're never going to come to your house. And I said, yeah, I mean, I don't have a problem with that, right? In certain situations, if it's requested, yeah, I'll go to your house and I'll go through the whole process with you. And that's what I did. I went to go visit them at their parents' house, went through the whole process
Okay.
from beginning to end. Here's how it is. And it turns out that they're very high qualified borrowers. So They were what you would consider A-plus borrowers. So
Love it.
you want to inform our audience as to what an A-plus borrower is?
I'd love to. I mean, an A-plus borrower is what I refer to as the loan officer's dream, right? They've got great credit. They've got great income. They've got stable, reliable, and continuing employment. And they've got a bunch of money in the bank. Those are the 4 characteristics that I always talk about for loans is income, credit, assets, and make sure your employment is very, very stable and reliable. Or you've had a great track record of employment. So they had all those things.
Yes.
And they got the benefit of being a first-time buyer, which affords them other special aspects to the loan product.
Right, like a lower down payment, for
Bingo.
example.
Yep.
So yes, on paper,
All of it.
great borrowers,
Yeah.
right? Both had good jobs. One of them was, I believe, an engineer, and the other one was a veterinarian.
Okay.
And they had great credit scores, above 740, which
Love it.
in the mortgage world,
That's
above
considered
740, that's
excellent.
great credit,
Yeah.
right? Get you the best loan terms, best interest rate, and all that. So we went over the whole process, and they asked me, what is the difference between using you or using our bank? Which this is also important for us to cover because I'm sure a lot of people out there might be wondering the same thing,
Yeah.
right? I have actually come across people, and I believe this might be actually more common than we think, that people believe that it's better to use a bank. I've actually had people come to me and say, I always thought going directly to the bank was better because it's more reliable or maybe safer or more trustworthy, which I can see why the sentiment would be there for that,
Yeah.
especially with everything that happened, back in the mortgage crash of like, '08, that there were some shady lenders out there going, doing some crazy things.
Sure.
But even the big banks were doing that back then. So
Absolutely.
it's not
They were
necessarily
probably in the forefront of it. I mean,
Yeah.
the biggest lenders in the country were the ones doing the loans that ultimately folded those companies, like a Countrywide Mortgage. Not a big, bank like a financial institution where they're handling money. They were doing just mortgages, but like they were the number 1 lender in the country. So
right.
bigger with regard to banks or lending institutions does not mean better.
Right. Yeah.
I won't even say it does not always mean better. Does not mean better.
It does not actually, and I would argue that it's actually worse.
Yes, but they have the benefit of being the household name,
Right.
right? And there's a level of trust with a consumer if they're familiar with your name.
Right.
So I get that.
Yeah. But it is important to know that, especially nowadays, with so many rules and regulations that are in place, right?
Yes.
In the mortgage industry, all of us, whether you're a small boutique shop or a big bank or a broker, retail lender, whatever you are, we all have to adhere to the same standards.
Yes.
We all follow the same guidelines, the same rules, right? So it's not that your loan will be any better going to a bank. And remember earlier I said it might actually be worse.
Yeah.
Well,
Oh, I remember.
yeah. The reason why is because bigger banks tend to have a lot more overlays. You want to explain what an overlay is?
Yeah, I thought you might ask me to do that. Yes. Obviously, an industry term, a piece of jargon that we use, but it does make sense. So there are, like you said, we're all heavily regulated, right? Compliance and guidelines. So of the big 3 mortgages, let's call them conventional, FHA, VA, there are other products out there, even like a USDA falls under government regulation. But these big 3 have government regulated guidelines. Okay, Fannie Mae and Freddie Mac are the government agencies that oversee conventional loans. Whereas FHA, overseen by HUD, right, the Department of Housing and Urban Development, VA, Veterans Affairs. Your clients were using conventional?
Yes.
Okay. So conventional loan guidelines are very clear. Here's what you have to do to execute and perform a conventional loan. At a minimum, your borrower must meet these requirements. So banks and lenders know, okay, we got to do that. But banks and lenders are also allowed to say, well, those requirements are great and we're going to meet those. But some of those pieces are a little bit risky even for us, even for our risk tolerance. So we're going to have extra guidelines on top of those. Those are called overlays.
Yes.
I can list some if that's where we're
No,
going.
that's perfect. Long story short, it's basically a guideline on top of a guideline. So
Yeah,
at
an
the
extra
bare
hurdle.
at the bare minimum, we have to follow the guideline that conventional loans have.
Correct.
But banks usually have a lot more rules and regulations on top of that.
Mhm.
Why? Well, because the bigger banks have the luxury of being selective. They can choose to only do loans for A plus borrowers,
Sure.
right? Just because conventional loans allow for a credit score of 620 doesn't mean that the bank has to take a credit score of 620. They could say, we only want credit scores above 700.
Totally.
You can't remove guidelines, but you can add guidelines.
Yep.
So, arguably, bigger banks usually have more guidelines. They have a lot of overlays. They usually require higher credit scores. They require more documentation. They're a lot more strict
Yep.
with the documentation that you provide. So, for example, you could have two situations that are exactly the same documentation, and the big bank could say, no, I don't like that. I'm not going to approve your loan.
Hmm.
And another lender could say, yeah, sure, no problem.
Right.
The loan approved.
Absolutely. This is too risky for us because of X, Y, or Z.
Right.
This guy says, no, you meet the guidelines. You meet the government guidelines, we'll do it.
That's why, bottom line is, I believe it could be worse to go with a big bank than to go with like another lender, like a retail lender or a broker and things like that. Not to mention that we haven't even talked about the customer service aspect of it.
Right. Which
Right.
I don't think we're going to. There's not enough time in this episode. But the funny thing to me is that you already said your clients were A plus paper. I said the loan officer's dream come true.
Mm-hmm.
So they should meet all of these guidelines in spades, have no problem.
No problem.
And yet, here we are, episode 3 of Mortgage Nightmares. And
There's a
we're
reason
talking
why we're talking about it,
absolutely.
right?
So
Yeah.
they obviously decided to go with Bank of Erica.
No.
Oh,
No.
Okay.
They did not.
tell me more.
Okay. So I explained to them pros and cons. They decided to use me. And I even explained also about getting offers accepted, because sometimes if you have a seasoned listing agent
Mhm.
who is representing the seller, if they've dealt with bigger banks before in the past, then they already know that it might not be the easiest to deal with the bigger bank.
Yeah,
You can't just call them on a Saturday and say, hey, what's going on with the loan, right?
they might have had their own mortgage nightmare
Yeah, they might have had
with
their own
that
mortgage
big
nightmare.
bank. Yeah,
So you're not supposed to really, I mean, correct me if I'm wrong, but I don't think you're supposed to discriminate like that against lender to lender if you're the listing agent representing the seller.
whether or not you're supposed to, it happens.
It happens. It happens because the job of the listing agent is to advise the seller as to which offer they believe is a good offer to accept.
Right.
Ultimately, it's the seller's decision, but the listing agent does advise.
Absolutely.
And if they can tell them, well, you know what, I've worked with this bank before in the past and they weren't always the greatest, and we have another offer that's pretty much the same, but they're using another lender,
Mhm.
they might want to
That
use
could
that
be what
other
tips
lender
scales.
and not use the bank. So I
Absolutely.
explained that to them as well. Let them know like you most likely will have a better chance of getting your offer accepted, using us versus using the bank. All these things, I explained everything to them. They said, okay, great, let's move forward. They went to go look for a home. They found a home. They submitted the offer. They used my pre-approval letter. And then, once we got in the contract, they decided to switch over to their bank. Which, by the way, for those of you listening, please don't ever do that. There's a lot of work that we put in
Yeah.
to this, and we don't get paid until the transaction closes. So to use a loan officer just to get your offer accepted and then flip it at the last minute to somebody else, that's not cool.
No, and you know what? Especially if that loan officer took the time to go to your house and meet with you and your parents,
Yeah.
right? Picked up the phone, called the listing agent, spoke highly of you, told them all the things you were going to do. Offer accepted, pulled the rug out from under them. Listen, it happens. We've all had it happen to us.
Mhm.
It will happen after this show airs.
Yep.
Probably to both of us in our careers many times over. But I agree, man. It's not a great feeling.
And why did they do that, you ask? Great question.
Oh yeah, I did, didn't
Great question. The reasoning behind it was that they already have their checking account through them, so it would just be easy to set up auto pay through that same bank, and they were able to offer them like a slightly lower interest rate,
I?
which the lower rate was nothing. I mean, we're talking about like an eighth, something that we could have easily matched. Nope, no problem. We could have easily matched the rate. Bottom line, it was just a comfort thing. We're comfortable with this bank, and we just want our payments to go to them, which to me was strange because you can set up auto pay on any loan, on any mortgage,
Absolutely.
and it can come out of your bank account. It's not a big deal. But again, people have their things. They're okay, fine. There was no way for me to talk them out of it. Great, you're allowed to use whoever you want. It hurt, but what else can I do?
Yeah.
Right? So they go through the whole transaction, and thank God, I left the loan open. Because for those of you who don't know, when someone tells you that they're going with somebody else, that loan, you're supposed to cancel it because you don't just leave a loan open forever.
Right.
That loan eventually.
Compliance issues.
Yeah. I mean, you do have some time, right? It doesn't have to happen right away, which is why I left it open because I thought, okay, well, just in case, let me leave this loan open. If they have any issues, at least they'll have a backup. So that's what I was. I just left it as a backup, and it's really good that I did because I believe it was a week before closing. All right. And now normally escrow is like 30 days.
Yeah.
Right. So they went through everything.
So they've been 3 weeks, let's call it, in the process already.
They've been through their inspections, their appraisals,
underwriting,
negotiations with the seller on requests for repairs, everything.
disclosures,
right?
Conditions.
All that. Starting packing everything.
Yeah.
Right? Because you're towards the end.
Oh, yeah.
And bank. Oh, shoot, wait. I'm not supposed to say their name. I almost said their name.
He said Bank of America.
Erica.
Can we bleep that?
Yeah, I'm sure I can bleep that. Oh, man, I don't want to get sued. All right. They denied their loan.
Oh, they actually formally denied it.
They formally, basically they said, if you can't get us this document that we're asking for,
an extra
we
condition.
cannot give you the loan.
Right. I think it's a good idea to explain the underwriting process.
Sure.
So pretty typical, right? The loan goes to underwriting, and the underwriter is the final gatekeeper who says you either get approved or you don't. They have the decision. They have the power. But 99.9% of the time, your loan goes to underwriting. Underwriting says, okay, you're approved conditionally. Like, I'm going to put these couple requests out there, and as long as you can satisfy X, Y, and Z, we'll get you approved. And it could be things like, well, we don't have your appraisal back yet, so we need to make sure that comes back. You got to lock your loan still. Like stuff that's part of the process. Just hasn't happened yet. It could also be things like, hey, your pay stub is still 2 weeks old, send a new one in, an updated one. Or we need to verify your employment with your employer. But oftentimes, conditions from somebody like Bank of America might be like above and beyond, like absurd requests in the eyes of kind of a normal retail lender like you and me. So Bank of America came back and requested something that they probably weren't going to be able to satisfy. Is that correct?
Yeah. So that's exactly what happened. They went in for conditional approval, which is the first one, right?
Mm-hmm. Yeah.
The first one. Then they came back with a bunch of conditions. They went, gathered the documents, submitted them again. When they went in for final approval, what happened is that the wife, who was a veterinarian, she had gotten hurt at work. So she had time off because she was on workers' comp.
Got it.
Right?
Okay.
Now, workers' comp, usually there's paperwork. You can paper trail everything.
Absolutely.
Everything's documented. From the claim to how much you were getting paid,
to the time
to
you
the
were off.
doctor visits, the time you were off, everything can be documented. So she provided all of that documentation.
Was she off during the transaction or like
No,
previously during the year?
no, it was like within the year, so
Okay.
it was pretty recent.
So she's already back to work,
Right.
back to her regular schedule,
Yeah.
hours, pay, all of it.
Yes, because
Okay.
usually the underwriter wants to go back as far as 2 years and see your 2 year history.
Yeah.
If it happened 3 years ago, they might not care.
Right.
But in this situation, it was within the year. Yeah, she was back at work, full time, full pay, everything, which is why it really shouldn't have been an issue. But they basically reviewed everything that she submitted,
Mm-hmm.
and they conditioned for I don't even remember exactly what it was, but it was something that was almost impossible to get. I mean, they were asking for like a letter from the doctor that had helped her, stating that she is fully well, and like this whole list of things that it has to say, written
Whoa.
by the doctor, signed by the doctor, and she's like, the doctor's not willing to provide that. It's
Man, that almost sounds like an invasion of privacy.
it
When you start getting into like medical records, that's risky
it
business.
definitely seemed excessive.
Yeah.
All right, it seemed
Yeah.
excessive because it seemed like with what they had, that should be enough.
Sure.
And obviously with a bank, you can't really argue, you can't really fight it. It is what it is. You either provide the document or you don't. And they weren't able to provide the document, which is when I got the phone call.
Mm-hmm.
I got the phone call from the wife. She said, "Here's the situation. Is there anything you can do to help?" I said, "Let's try." So luckily, we still had the file open.
Sure.
I got all the documents that she had sent to them, had our underwriter review it, and the underwriter said, "Yeah, this is plenty.
Right.
This is plenty documentation for that time that you were on workers' comp."
Especially if she's already back to work. That's what
Right.
blows my mind.
Exactly. So they came over. They came back over to me. We got everything. Put a rush on everything. We were a week away from closing, so we had to get a little bit of an extension.
Mm-hmm.
But we were able to close in like a week and a half, insanely fast. We got
Heck
it
yeah.
done. Extending it for like another week was not a big issue to the sellers. They
Sure.
completely understood, because obviously from the seller, they would rather have you figure out your loan situation and close
Right.
than have to go out and find a whole new buyer. Right?
Right.
That's too much of a pain
Well,
for
and
them.
that's probably an opportunity for you as a good loan officer to call that listing agent directly and say, "Look, I'm not going to hide behind anything. Here's exactly what happened.
Absolutely.
Here's my plan to save it. We're already off and running. We've already done this, that, and the other thing."
Yeah.
But you wouldn't get that from a particular other institution necessarily.
Right.
Yeah.
So that's what I meant when I said it had a good ending, because ultimately they were able to close. We were able to save their loan, but we didn't have their loan locked because they weren't doing their loan with us.
Sure.
They had locked over there.
And let me guess, the market moved.
The market moved.
Mhm.
So you can't predict the market. The market either goes up or it goes down. At that particular time, the market worsened. Rates got worse. So by the time that we took over the loan, they had to lock a higher rate than they would have had if they would have just stayed with me from the beginning.
Gotcha.
So that's why I said it was
Kind
still
of
a happy ending.
But they took their medicine.
But yeah,
Yeah.
it kind of, they kind of screwed themselves over
Wow.
in that manner.
But they got their keys thanks to you saving the deal.
They got their keys, saved the deal. Moral of the story is be careful working with bigger banks, because they do have more guidelines, more rules, more regulations, and their underwriting is a lot more strict. They're very, very picky on who they're going to give a loan to.
Yep.
And even if you think that you're a perfect borrower, as you can see in this situation, it really doesn't even matter, because any little thing that they could pull up and say, "No, we don't want this." Because remember, most banks are keeping the loans on the books, the
Mhm.
bigger banks,
Right.
versus retail lenders that are actually transferring the loan to another servicer.
An open market,
Yeah.
somebody else could purchase it.
Right. So they're very picky about what loans that they want to keep on their books.
Right.
And they don't care about denying you. They
Yeah.
don't care about saying, "Nope, sorry, move on to the next."
They have the power to choose the A++ paper.
Exactly.
Yeah.
Yep. Yeah, so that was it
Wow.
for today. Thank you guys so much for tuning in. Stay tuned for next week, where we have another actually really good story.
I know. I'm already
Yeah.
looking forward to that one.
I know. Next week is it's a good one. The one next week hurts. It hurts. It hurts my heart. It really does.
Does it?
Yeah, that one didn't have a happy end.
Yeah.
Unfortunately.
Don't
So
don't
hey,
say anymore. It's a great tease.
I'm not gonna say anything else. We're gonna have a good mix of of a good ending.
Yeah.
I gotta stop saying the word happy ending.
You know what, just roll
That has
with
a
it.
different connotation
fine.
sometimes.
No, it's
A
good.
different meaning. A good ending. A
There
good
you go.
ending. And some that aren't. But the whole purpose of this show is to help you to avoid a mortgage nightmare of your own. Thank you, guys.